All right, in this last lesson of consolidations, we are going to talk about one more entry, but before we talk about this one more entry, let's talk about what we've already learned. So in this case, we're talking about consolidations. Consolidations happen at the end of each year or at the end of the first year, depending on how we consolidate and if we have a statutory merger or not. But in any case, what's happening is I own an investee or a company B, and at the end of the year, we need to consolidate to show one financial statement that we have both of our numbers on. We either need to do that at the end of the acquisition year or every single year afterwards. So this may be 7 years down the line, and so we're consolidating and we're talking about all of these entries. Now, what we've been talking about until this point is using consolidation under the equity method. What do we mean by equity method? Equity method is we have an investment in company B's account and we just adjust it for income or decrease it for dividends, and we keep doing that year after year. There's actually two more ways that we can actually count or keep track of our investment in company B. We have another way called the initial value method, and we also have the partial equity method. We haven't talked about that because we started this advanced accounting with the equity method, and so it was easy to start with equity method when we talk about consolidations, but there's two more. There's initial value and partial equity, and we may get a chance to talk about that later on. So this last lesson completes this idea of consolidation under the equity method, and we've already seen this entry at a high level before a couple lessons ago. Now we're just going to talk about the entry. And so what we have is consolidation entry P, and this is the elimination of an intra-entities accounts payable. Now you can use this for an accounts receivable. We're calling it payable, but either way we're eliminating intra-entities payables, liabilities, or assets, or one of those two. And so let's talk a little bit about what the consolidated balance sheet looks like. Now, this is just kind of a focus on two balances, due from company A, due to company B. This is company A's trial balance, this is company B's trial balance, and this is the consolidated amount before this entry that we're going to talk about. Notice here we have due to company B. So this is a liability. Liabilities are credits normally. And so they have a liability of $10,000 that they owe to company B. On the flip side, company A as an asset has $10,000 on, so company B has $10,000 owed to them from company A on their trial balance. That's why there's a $10,000 there. It's a debit balance. At the end of the day, if you net them out, they net to zero, right? Okay. Now remember, the third thing that we're going to do is we are going to eliminate intra-entity transactions. In this case, we're eliminating liability and an asset. And so if we add just across, we still get 10,000 there and 10,000 there. On a consolidated balance sheet, we're going to have to show due from company A, due to company B. When we're consolidating, though, on our consolidation worksheet, we're going to make consolidation entry P, and that is going to be a debit to company B for 10,000 and a credit to company B, due from company B for 10,000. What does that do? Well, this debit right here, due to company B, eliminates this, right? Because this is a credit. Opposites of credits are debit. So if I were to debit this, I get a zero. That means I don't need this account anymore. Credit due from company B, okay? Actually, company A. Due from company A for 10,000. By crediting it, I have a debit here. If I'm going to debit here, credit there, that cancels that out. So now I've eliminated my intra-entity transaction. So this is a very short lesson. It's just really to kind of show you this right here. If we consolidate it like we were supposed to, we're still going to have two balances here. We're going to do consolidation entry P. P as in payable. Payable will eliminate the two entries here by using these. So due to company B for 10,000, due from company A for 10,000, debit and credit, that eliminates these. And now we don't need these accounts. So when we consolidate or we do the consolidated financial statement, we won't even have these accounts because they're all at zero. So that's kind of the last little thing as we talk about in consolidations using the equity method.